We're looking at an analysis of Reviva Pharmaceuticals, or RVPH. The report focuses on its drug, brilaroxazine, as a speculative, catalyst-driven play.
Right. And it captures that high-risk, high-reward energy really well. But I think we can add a lot more analytical depth.
I agree. Let's jump right in. The first point is this. To really sell those extreme upside price targets, the analysis has to build a much clearer bridge between the successful Phase 3 data and the analyst valuations.
Yeah, that's the core of it. Because right now, the report presents two things as, separate facts.
What? The trial data and the price targets.
Exactly. On one hand, you have the fantastic RECOVER trial outcome, symptom reduction, fewer side effects.
Great. And on the other, you have these, let's be honest, wildly aggressive price targets, an average of almost $6 with a high of nearly 17.
And there's just this massive gap in between. The report basically says the science is good, therefore the stock could go up 2,400%.
But it doesn't explain the why. Why does this specific clinical success justify that specific valuation? It's a huge logical leap.
It is. So the suggestion here is to fill that gap with context. We need to talk about the market. Schizophrenia treatment is, it's a massive space.
And the competitive edge for RP5063 is the key here. Why is this drug actually a potential game changer?
But hold on, couldn't someone argue that the analysts have already done that market sizing? Why does the report need to repeat it?
That's a fair question. It's because the conviction for this kind of investment doesn't come from just trusting an analyst's number.
Right. It comes from understanding the story. And the story here is about the failure of the current drugs.
Okay, so you mean the standard of care treatments?
Yeah, things like olanzapine, risperidone. They work, but the side effects, we're talking severe weight gain, metabolic issues, cardiovascular problems, are just awful. Patient drop-off rates are incredibly high because of it.
So the value proposition isn't just that brilaroxazine is effective, it's that it's effective without those deal-breaking side effects that plague the current multi-billion-dollar drugs.
That's it. That's the whole thesis. And that's what makes a $16 or $17 price target even remotely plausible.
So the analysis needs to spell that out.
Absolutely. So for a concrete example, instead of just quoting the number, break down what it implies. A $16 price might suggest, a market cap that assumes $1.5 billion in peak annual sales.
And then you can connect that back to the market. So you'd say something like, okay, the total addressable market for schizophrenia is huge.
Right. Frame it as a calculation. You could say, if brilaroxazine's better side effect profile lets it capture just, say, 3% of the existing patient pool, mostly people who quit their meds, that alone could mean X million in revenue.
And that revenue number is what underpins the analyst targets in that $5 to $8 range.
Exactly. All of a sudden, it's not just a random high number.
It transforms the idea from a sort of generic high-risk bet into a calculated one, based on a really specific and defensible edge in the market. That makes the upside feel earned.
It grounds the hype in reality. It's the difference between an opinion and a thesis.
Okay, that leads us perfectly into the second point, which is the other side of the coin, the financial reality. While the analysis does a good job of flagging the massive risk of dilution, it really needs a quantified scenario to make the massive reward part of the thesis feel robust.
Yeah, this is the classic problem with any early-stage biotech, isn't it? The cash crunch.
For sure. The report identifies the catch, that Reviva has only about $13 million left. That's not a lot of runway.
Not at all. And they need a lot more cash to get them to their NDA submission in 2026 and then actually commercialize the drug.
But the weakness in the analysis is how it frames this problem. It's treated like a simple hurdle that, good FDA news will just magically solve.
Right. It minimizes the risk. It's not just an obstacle, it's a potential thesis killer. Extreme dilution could completely wipe out the upside, even if the drug is a blockbuster.
But again, let me play devil's advocate. The target reader for this is a risk-tolerant investor. They know dilution is part of the game. Why do we need to spell out the numbers?
Because the scale of the potential dilution here is massive compared to the company's current size. An experienced investor prices in some dilution, sure. But RVPH might need $50 million, maybe more.
Okay.
And if they have to raise that money at like 50 cents a share before any good news hits, the share count could double or worse. That could permanently cap the stock price, no matter how good the drug is. We have to define that worst-case scenario.
So the suggestion is to add a brief quantified scenario. Show the math on what the worst-case dilution could look like to get them to 2026.
You have to. It's essential. The analysis needs to run the numbers. For example, let's say they need 50 million. Let's assume they raise it at a deeply discounted price of, say, 50 cents a share.
Okay, so you calculate the number of new shares that creates.
Right, and then you calculate the percentage increase in the total shares outstanding. Let's say it's a 60% increase, just for the sake of argument.
That gives the reader a concrete hurdle. It tells them that the drug's future success has to be big enough to first absorb that 60% hit to value.
And then still have enough upside left to reach those targets of $3, $4, $5 a share.
It changes the conversation from a general worry about cash to a defined, measurable risk.
Exactly. It's an informed calculation. You're no longer just hoping for the best. You're weighing a quantified risk against a potential reward. That's investing, not gambling.
It's about sophisticated risk assessment. It keeps the excitement but forces you to confront the real cost of getting to that reward.
Precisely. Which brings us to the third point, which is really about the packaging, the tone.
Right. So the report's aggressive use of hyperbolic language, which is clearly designed to grab your attention, might actually be undermining the credibility of the science it's based on.
I see what they were going for. I really do. Using terms like loading the boat, casino play, scammer moonshot.
It's very high energy. It definitely catches the eye and fits the Lotto play theme.
It does, but it creates this really strange dissonance. Well, all that language, casino, lotto, it all suggests random chance, pure luck. But that completely clashes with the facts that the report itself presents. This drug works. It has positive phase 3 data from the RECOVER trial. It has 6 analysts calling it a strong buy.
So when you call it a casino play, you're kind of devaluing the very scientific rigor that makes it an interesting investment in the first place.
You're devaluing your own evidence. It's a really good point. The sensationalism almost makes it sound less serious, maybe even like a pump and dump, which is not what the data suggests at all.
So we need to find a way to keep that high-octane energy without sacrificing the credibility that comes from the solid clinical data.
Exactly. The suggestion is to adjust the framing. Keep the excitement, because this is a high-risk, high-reward situation. But you need to emphasize that it's an informed speculation. It's a conviction play based on technical data, not just, a roll of the dice.
So how do you do that in practice? What kind of phrasing gets that across?
You just swap out the most volatile language. So instead of loading the boat or casino play, you could use something that highlights both the risk and the science.
Like what?
Something like a high-conviction, catalyst-driven trade based on the RE-covered trial's efficacy. Or maybe a calculated speculation ahead of a critical regulatory binary event.
I like that. It still sounds exciting and risky, but it also sounds smart. It sounds evidence-based.
And that change in tone needs to extend all the way to the call to action at the end.
Right, which currently focuses a lot on watching the technical stock chart, like the 55-cent support level.
Which is fine for a trader, but for an investor, the real story here isn't the chart. It's the regulatory pathway.
Good point. So the call to action shouldn't just be about stock prices.
Not primarily, no. It should be about watching for the real milestones, things like updates on their talks with the FDA, any financing news, which we just discussed, or maybe partnership announcements.
Because those are the actual events that will drive the value and validate the whole thesis.
Exactly. Shifting the focus there reinforces the idea that this is a strategic investment based on fundamentals, not just a gamble on market sentiment.